This week is no joke. We've got a looming government shutdown, a Quantico meeting nobody trusts, and price actions stuck in a vice grip. But here's the thing. Range contraction never lasts forever. That means range expansion is coming, and I'm going to show you exactly how to trade it. Bullish above, bearish below, with precise targets and stops. Let's dive in. If you're getting value from this breakdown, drop a like. It helps the channel and lets me know you want more deep dive playbooks like this one. Let's talk about the big picture, the shutdown factor. Let's zoom out. Historically, government shutdowns tend to spark volatility, especially when we're trading near all-time highs like we are now. This isn't about politics, it's about uncertainty. Markets hate uncertainty, and dealers will often pin price into expiration until that uncertainty resolves. That's exactly what we're seeing now. SPY stuck between 6,640 and 6,660. The elephant in the room is this range contraction, which will soon become range expansion. Tuesday was a chop fest, with price contracting into a tight band. Remember the rule. Contraction leads to expansion. The expansion day is usually Wednesday, right when we flip into a new month, and right when headlines about the shutdown start dropping. Here's my playbook, but before I share my exact levels, guys, hit that subscribe button and turn on alerts. We break down SPY, Tesla, Nvidia, and more every week, so you can trade with confidence, not guesswork. My bullish above plan. My trigger, hold above 6,656. My confirmation, 15-minute close above 6,661. My targets, 667.3, then 670 to 677. Stretch to 674.9 to 676.7. My stop, lose, 6,647 neckline. Now here is my bearish contingency plan. My trigger, failure at 6,656. Roll back under 6,647. My confirmation, close under 6,624. My targets, 661, then 659.3. Stretch to 657.4 to 654.4. Stop, any reclaim of 6,647. This is my shutdown playbook. Simple, actionable, and built for traders who respect risk. Now, look at the option chain. Puts 5 to 8 strikes down are way more expensive than calls 5 to 8 strikes up. That tells you dealers are pricing in more downside risk than upside reward. But it also means if price breaks out to the upside, those cheap calls can explode, because dealers are underhedged there. That's why 6,660 to 6,670 is such a critical pivot zone. This week isn't about predicting headlines. It's about reacting to levels. The government can delay, Quantico can spin whatever story, but SPY doesn't care what the reason is. Price tells the truth. Respect the levels, stick to stops, and let the market pay you. So here's the takeaway. If SPY holds above 6,656, we target the 6,670 to 670 zone. If it loses 6,624, we press short into 659 and lower. Headlines may create the excuse, but price action will tell the story. This is my shutdown playbook. Trade the levels, not the noise. As we approach the October 1st expiration, the options chain is sending a very clear message. The market is caught in a tight band between 6,600 and 6,700, with both sides making a strong case. Traders should expect pin risk in this zone, while the larger directional move may be delayed until after October 11th OPEX, What today's chain is telling us, October 1st, 2025 expiry. This is aggressive call buying right near resistance. The 6,700 level is being treated as a possible magnet. On the call side, the 6,700 strike has become a focal point, with nearly 9,800 contracts traded and open interest around 5,600 contracts. Pricing remains relatively firm at 450 to 470, suggesting that buyers are treating 6,700 as a potential magnet for price into expiry.
Meanwhile, on the put side, the 6,600 strike has seen 6,000 contracts trade with open interest of 3,200 contracts. At 295 to 310, these puts remain actively defended, highlighting 6,600 as an important support level. The net effect is a 100-point battlefield, with 6,600 anchoring support and 6,700 attracting upside flows. This narrow range suggests pinning around 6,630 to 6,660, unless either side is broken decisively. Bears are paying up to defend the 6,600 level, showing they're still protecting the downside. This is where things get interesting. That expiration typically draws institutional flows, hedging, and rebalancing. I'll need to see where the OI stacks up on the 6,600 to 6,700 band versus the further strikes, e.g. 6,500, 6,750, 6,800, to really define gamma positioning. While the October 1st expiry is shaping the near-term action, the real story develops into the October 11th monthly OPEX. Historically, this expiration draws heavy institutional hedging and rebalancing, creating the conditions for a larger move once the near-term chop resolves. Core skew remains surprisingly cheap, with upside premiums relatively low compared to downside puts. This points to a defensive hedging environment, where institutions remain more concerned with protecting against drawdowns than chasing rallies. Into October 1st, the market appears likely to remain trapped in a 6,630 to 6,660 pin zone. However, the real directional move may not arrive until after October 11th, OPEX, when dealer positioning and institutional hedging flows clarify. For now, traders should respect the 6,600 to 6,700 band as the battleground, while keeping one eye on how open interest builds into OPEX. If open interest begins to accumulate meaningfully at the 6,700 to 6,750 call band, it could create the conditions for a gamma-driven squeeze above 6,700. Conversely, if puts continue to dominate at 6,600 and below, dealers will likely be forced to head short, leaning the tape lower and increasing the odds of a rug pull event. Based on what I'm seeing so far, calls are surprisingly cheap relative to puts. Skew is defensive, hedgers still paying for downside insurance. If institutions pile in between 6,600 to 6,700 on both sides, expect pinning around that band until after OPEX. If call volume accelerates at 6,700 to 6,750 into October 11th, that opens the door to gamma squeeze fuel above 6,700. If puts continue dominating OI at 6,600 and below, dealers will likely head short and lean the tape back down. Stops should be tight, since this chop can bleed accounts. Think scalp to swing sizing until the gamma/OI picture clarifies into October 11th. My take. Into October 1st, expect chop to pin between 6,600 to 6,700. After that, October 11th OPEX becomes the real battleground, where the bigger directional move will form. either a squeeze over 6,700 or rug below 6,600.
Thanks for watching, traders. Comment below, do you think the shutdown becomes the rug pull catalyst, or will SPY grind higher anyway? I want to hear your thoughts. And as always, manage your risk. Take profits when they're there. And I'll see you in the next video.